Hello everyone, my name is Teena Mathur. I am assistant professor in Biyani Girls College. Today I would going to deliver a lecture on the topic cost of capital. I welcome you all on behalf of groupkpo.com. So my topic is cost of capital. Cost of capital. Every organization or every concern has to pay certain amount of money on the sources of capital which he has obtained. It is a minimum rate of return which every organization must earn on its investment to pay to the cost or the sources of capital. So let's discuss about the significance of cost of capital. So the first importance is it is helpful in capital expenditure decisions. Through capital expenditure decisions, you can actually compare your net present value or your profit and your cost, and through you can take decisions that which project is profitable. And the second significance is it is helpful in capital structure decision. You can actually determine your capital structure on the sources or the cost of the sources of capital. Now, the next point is it is helpful in comparative evaluation of various sources of finance, which means you can actually compare that from which source there is more cost, and you can actually find out that which is more profitable and which is not profitable. And the last point is it is helpful in evaluation of financial efficiency of top management. Top management efficiency can also be evaluated through its cost of capital. Now let's discuss about the various sources of capital and how to determine its cost. So the first source of capital that we have taken is cost of debt, which includes debentures, bonds and long-term loans. Now when debentures are irredeemable, means which we don't have to repay, so its formula is R divided by NP into 100. R is rate of interest that we have to pay on our debentures, and NP is the net proceed that we get after deducting all the expenses on the issue of debentures. When debentures are redeemable, it means when we have to pay off our debentures after a specified period of time and with a fixed rate of interest. So its formula will be, when we have to calculate cost of debt capital, rate of interest plus maturity value minus net proceeds divided by N divided by MV plus NP divided by 2 into 100. MV stands means the maturity value, N stands for number of years to maturity, and R stands for rate of interest, and NP we know that it is net proceeds that we get after deducting the expenses for the issue of debentures. Now our next cost of capital, the source is cost of equity share capital. We all know equity share capital is the owner's fund that we need to give after deducting all the interest, debentures cost, preference share, and at the end the remaining amount we pay to our equity shareholders. So its cost is, so the first method that we used in determining the cost of equity share capital is dividend yield method. Its formula is DPS, when we calculate through dividend per share divided by what is the market price into 100. And earning yields methods, its formula is when we calculate it through earning per share divided by MP into 100. And the next is a combination of dividend yield and growth in dividend method. Its formula is DPS divided by MP plus growth. Now in case of cost of newly issued equity share, we use NP instead of MP. So when we have to calculate newly issued equity share, we will use net proceeds instead of market price. Now our next cost of capital is cost of retained earnings. So as we all know that from our profit, some portion is kept for the equity shareholders and sum is retained in the business. So retained earnings is a surplus profit that we kept in the business for future diversification or invest in various projects. So in the cost of retained earnings, it's KR, it denotes retained earnings. So its formula is cost of equity capital divided by 1 minus TP into 1 minus B. B is the brokerage cost and TP is the personal tax rate for shareholders. And its formula is also D into 1 minus TP into 1 minus B divided by market price into 100. And another formula is E into 1 minus TP into 1 minus brokerage divided by MP. And one more formula is there, dividend per share divided by market price into 100 plus growth rate into 1 minus TP. TP is personal tax on shareholders and 1 minus B is brokerage. And so these are the various formulas used for the calculation of cost of retained earnings.